Yeah, so tell us a bit about the Australian economy, David. How are you seeing things at the moment?
Well, we actually had a couple of pieces of good news this week. I mean, we had retail sales out, had a pretty strong number in May, and we had another strong number a couple of months earlier. So these numbers do chop and change month to month. They're quite volatile, but it's fair to say that the retail sales have strengthened so far this year relative to where they were last year. So, retailers, there's a little, I wouldn't say huge cause for celebration, but the interest rate cuts we had are now starting to slowly filter through. The other big news was a big jump in building approvals for apartment blocks in particular. So, again, they tend to be volatile, but it is a sign of more work in the pipeline and potentially a bottoming out in home construction.
Just looking at that graph, it looked like the trend, even though it was a big spike in the latest month and probably just out of the trend, it looked like the trend was still downwards.
Well, yeah, it's too early to say there's a turn in the trend, but I mean, if you look at the fundamentals, I mean, we are sort of still short houses. Affordability is getting a lot better. We have had interest rate cuts. Housing prices are sort of showing signs of stabilising. I think the latest June numbers showed a small rise. So fundamentally, the conditions are there now for a turnaround in the sector. Interest rates, there are a lot of other problems in the sector. It is very expensive to build a home in Australia, which is one of the problems of getting a lot of construction through. But I think with the rate cuts we're having, we've certainly seen the worst, I would argue.
What about Europe and elsewhere, but in China, around the world actually? What do you make of the ECB and the People's Bank of China cutting interest rates on Thursday,
yes,
and then and also the Bank of England doing some more money printing?
Well, I mean, I would like to say we've seen the worst in Europe as well, but I fear if we haven't. I mean, ECB is basically doing all it can do is cut rates. I mean, rates in Europe are already very low. They've cut them to 0.75%. China, I think China's more of an issue. I think the fact that China did cut interest rates for the second time in a row, I should say, is maybe a little bit of a worry, because they tend to cut rates in advance of weak economic data. So maybe the Chinese authorities are getting a little bit concerned with their economy. So I wouldn't see that as great news. The Bank of England, again, interest rates are already at rock bottom levels. All they can do is sort of try to print a bit more money, is sort of what the United States can do. I mean, the problem in all these countries now is interest rates are so low, their economies are still struggling, that it's a really flat chat to try to do much more.
They're zero bound. And America, as you say, America's pretty well got zero interest rates. We've got a little clip of Christine Lagarde talking about the US economy, and she's lecturing them, telling them to do more.
I would say that, first of all, the US economic recovery remains tepid, and downside risks have intensified. Continued policy action is needed to boost the recovery. We believe that the US authorities do not have a lot of space available. They have limited space, actually, to act, but they should use it to support the recovery in the near term.
Ivor, the market's been rallying pretty hard last 5 or 6 weeks.
But nowhere near as good as the news is. I mean, the news, particularly in the Australian economy, has been pretty robust. As David said before, there's signs retail's rebounding. We've had really strong car sales. Flight Centre, the biggest travel chain, has upgraded. There's actually some positive momentum going on, but really the market's really only had a very mild bounce, and we've underperformed the rest of the world by a mile. So there is still a great lack of confidence amongst Australian investors.
Certainly in retail, none of the retail companies are suggesting that they felt anything from this yet. Nothing coming out of the budget, nothing coming out of the carbon tax give-outs, handouts, and, really they're still saying, in fact, they're saying they're struggling more than they were this time last year.
Yeah, I mean, the problem with our market, of course, is it's dominated by miners, it's dominated by financials, and miners, we're in we're continuing the concerns about China. Commodity prices are off. Financial sector, credit growth is still quite weak. It hasn't turned around yet. So, and banking generally is on the nose globally. So that's really what's been holding back our market.
What do you make of the roaring rally in Europe? 10% in not too long.
Equity markets have rallied, but bond yields, if you look at signs in the credit markets, they haven't. They aren't displaying the same degree of euphoria. Like Bond yields in Spain are still quite high. They come off a little bit, but still at worrying levels. Bond yields in places like the United States are still very low.
And
so
that
they
bounces off a very, very low base. So European stocks are still on single-digit PEs.
My experience has been when bond markets and equity markets are telling you different stories, it's usually bond markets that are right, unfortunately.